Good morning and welcome to the morning call for Thursday, the 27th of April 2017. Very quickly, we'll touch on sort of what happened overnight with the biggest ever tax plan in US history. It's pretty much already been released, and most of it is what you'd probably understand has been coming out from Trump's administration pretty much since he was actually voted in. It looks like there'll be a 15% tax rate down from 35% for the corporate, and they're talking about payroll tax cuts down to around 10%, and removing the bans from 7 bans down to 3, but at the same time removing any form of sort of tax deductions you get across the board to only remaining to 2. Question would be whether or not you get it through. Looks fairly tough with the current kind of levels. There's only one page of data. So that's why last night the US market was pretty mixed to it. I think they've priced it all in. We'd heard pretty much what the sort of rates were going to be. The question now is what the detail looks like, and yet we haven't really seen that. So I just want to move off that. I actually want to move and have a look at what's likely to sort of move over the next 2 weeks to 3 weeks while I'm away. Here in Australia, next week is going to be very, very interesting. And the reason I say that, it is bank earnings season, ANZ, NAB, Westpac. You've also got Macquarie in there as well, which happens Friday week. And they're going to really talk to you about probably the future of where they see banking, macroprudential rules, whether or not their capital, so their CET ratio, is currently in line or where they want to be, which is in the top 25% percentile of the world. And that's why last year you saw so many debt levels. I think the results are going to be relatively good. The question will be whether or not the market believes they can be sustained. Net interest margins are going to be one of the big areas. And then the one that I've always talked about, bad and doubtful debts, BDD, has always been suggested over the last 6 to 12 months particularly that it should actually start ticking up. What we've been seeing, however, is it's been still sitting at the very much at the bottom of the cycle. CBA showed you that back in February. And that is the area you really need to look at. And the reason for that is that it has such a ramification across not just the ASX, but the economy as a whole. If you do start to see that tick up, it means that the distress in the market is starting to move. And everybody comments that if you start to see particularly lending stress in the residential side, that consumption will slow down, GDP growth will start to slow down. And despite yesterday's CPI, inflation clearly is going to go back as well. That is all an Aussie dollar negative. It is therefore also an ASX negative. So just very much concentrate on what they are trying to tell you in the guts of that result and whether or not they believe that it's sustainable to continue to see loan growth going up. There will be record cash earnings numbers. That's a given. It's the sustainability and what happens over the next 12 months. And that will really give you a guide to whether or not the price is being justified. And the ASX above 5,900 points is actually about fair value on a 12-month PE ratio of 16.5 times and at the current EPS level. So that's the next question, is whether or not the banks actually leg up off the back of their results next week. And that's a really structural point to really concentrate on, because it's also May. And the old adage of sell in May, go away is probably likely to come true. And the reason I say that is that this month has actually sort of slightly bucked the trend. We're basically break even. In fact, if we sort of close today, it would actually be a positive month, only just, but that's quite a good thing considering April has been averaging over the last 5 years between a 1 to 3% decline. And therefore we are really building May up to be an incredible month to really hold on to those levels as well. I'm not bearish, don't get me wrong in any shape or form. I'm just very cognizant and very much on the idea that we have really run up and run quite strongly and are on the back of earnings that are coming from the banks, the idea that the US is doing quite well, and that is all true, but I wouldn't be upset with some form of pullback and giving me an entry point that's a little bit more sort of conclusive. Also, while I'm away, it's clear that you need to look at what's going on with France. We have the election on the 7th. I know that. Be aware margins will move, and therefore look at the 5th next week. That will be a bit of a change on in terms of where margins are for European exposures, and there will be a bit of volatility next week as well. Back half of May as well, leading into the Chinese numbers that will come out in June. They're also going to give you a really good gauge and a really good understanding about what might happen in the second half of the year. Finally, the last thing to look at over the next couple of weeks, the budget. And that will also be quite a point to really hone in on whether or not public purses are actually doing what they're saying they are, or whether or not the better than expected budget deficit, and it will be, I will guarantee you that it will be better than expected, is down to the actual fact that bulk commodities in the back half of last year were so strong. So what does it mean structurally for the economy going forward? And that's what you need to see from Scott Morrison. I know it's a big one today, and I do apologise for that. Have a great 3 weeks. As I said, Chris and Gary will be doing the morning call over the 3 weeks while I'm away. Looking forward to seeing you when I get back on the 20th. And with that, have a good trading period, And be aware that there are a few events out there over the next period that will be interesting, and they certainly will probably make up your trading strategy for the rest of the year.